Hello, it's Kevin Thompson here at 99 Capital Group, and thank you guys for your time on this wonderful webinar series that we're putting together for all of you. Today, we're talking about W-2s and business owners. Who actually pays more in taxes? We're going to go through that a little bit here. Again, I'm Kevin Thompson, founder and CEO of 99 Capital Group. I am a certified financial planner, a retired income certified professional, and an enrolled agent. You can find us on YouTube at 99cap, Facebook, Twitter, and Threads at MLB2CFP, which is also the title of my book that's now on Amazon and Apple. Also, today, what we're here to do again is just to talk about your questions, the questions that I've been getting. Who's really pays more in taxes? Am I better off as a W-2, or should I go into this independently as a 1099 or a sole proprietor? Taxes can be confusing, but understanding the difference between these income types can save you thousands of dollars. So by the end of this session, you'll walk away with some real strategies to reduce your tax bill, whether you're an employee, entrepreneur, or a side hustler. So why this matters. The average American pays over $10,000 a year in taxes. But how much of this can be avoided by smart tax planning? Business owners and W-2s are taxed very differently. And knowing how to optimize your situation can lead to huge, huge savings. So today we're going to look at some deductions, income structuring, and some advanced strategies for both groups. Let's talk about how taxes work for W-2 employees. It's not very difficult. W-2 employees have taxes automatically withheld from their paychecks. They rely on the standard deduction or itemized deductions. In general, since the standard deduction has gone up due to the TCJA, most of the people are doing standard deduction. A large proponent of people are doing the standard deduction. Then you also get like mortgage interest and charitable giving. But that's charitable giving and all of that's in standard deductions or in itemized deductions. But beyond that, W-2 strategies are limited compared to business owners. Now, there are tax credits out there, or an income tax credit that you get. But again, we can get those same things on the business side as well. On the business side, you get the business and the personal. We'll get to that in a second. So let's talk about how taxes work for business owners. Now, a lot of us see that self-employment tax. I know it gets hard sometimes when you see that 15.3%. But there's ways to mitigate that. But business owners have more flexibility. They pay more self-employment tax and must handle their own quarterly tax payments. But the trade-off, they can deduct a lot more. Home office expenses, meals, travel, and even certain insurance premiums. You have to be careful on your deductions. They have to be reasonable and justifiable part of your business. You can't just deduct any and everything of your life. It has to be justifiable, reasonable, or there's chance of an audit. So on the business owner side, like you mentioned here, we have self-employment tax. Most of the reporting is on Schedule C. Business income expenses are reported on Schedule C of the individual tax return, which determines the net profit and loss from the business. And of course, we get tax deductions. Business owners have access to a wide range of tax deductions, such as business expenses, like I mentioned, home office and equipment. Here's a side-by-side comparison. So notice how business owners have far more opportunities to reduce their taxable income. They have control over their deductions, retirement savings, and even how they structure their income. But they also have more responsibility when it comes to tax filing and payment. A lot of people don't understand that when you are a business owner, there's franchise taxes, there's sales taxes, there's all these different taxes that you must pay. And if you don't pay those, there can be some significant penalties. But again, on the self-employment side, again, so on the deduction side, 25%, tax withholding 30%, retirement options 15%, self-employment tax 15%. So there are some options there in regard to the business owner side of things. So let's talk about the standard deduction for W-2 employees. In 2024, the standard deduction is $14,600 for singles and $29,200 for married couples. To save more, W-2 employees would need to itemize deductions, which means tracking expenses like mortgage interest, charitable donations, and medical expenses. With the current TCJA as it is in this form today, and again, this is before TCJA 2, the expansion, but in the current form, the TCJA allows for a huge or doubling of the standard deduction from the original form, which allow a lot of people to forego itemizing. Very, very big point, and that's what they're trying to get past again, along with some other things that we're not going to discuss at this time. So business owner deductions, what can you write off? Like we mentioned before, home office, business meals. Business meals have been down to 50%. Business travel, health insurance premiums, depreciation, depending on how there's even bonus depreciation, retirement contributions. And one thing that I want to mention here from a deduction standpoint, um, outside of depreciation and health insurance premiums, um, and bonus depreciation, you can also write off, the things in your business. You can also write off some of the things outside of your business. What I mean by that is things that are greatly impacting you, like the biggest thing from a business owner perspective is going to be contracts, um, who you're paying, contractors, things like that. Those are cost. Those are input cost. Usually your highest input cost. So when you have these salaried employees or contractors, depending on if you're a sole proprietor or an overall employee on LLC with more than one or two employees, that's going to be one of the biggest costs. And then paying one half of the self-employment tax on their behalf if they're not 1099 structured. So there's a lot of different things here. So business owners can deduct anything that's ordinary and necessary for running their business. Like I said, common deductions, home office, travel expenses. Oh, I was going to say this from a deduction standpoint. Entertainment, no longer. So that's basically gone away. But this gives flexibility for business owners to take a huge advantage in lowering their taxable income. So what about you side hustlers out there? You Uber drivers, the Door Dashers. Yes, if you earn more than $600 from a side gig, the IRS expects you to report it. But you can also deduct these expenses related to the side hustle like equipment, advertising, and mileage. The key, keeping solid records and separating personal from business expenses. I'm going to give you this bit of advice. If you're doing this, open up a business checking account or a business account so you can separate, even a business credit card, so you can separate business from personal. You don't want to mingle those together because that can get really convoluted really quickly, and then now you have an audit on your hands. So if you have a side gig income, freelance work, ride sharing, something selling handmade goods, just make sure you're doing it the correct way. Make sure you're really separating your business and you're really keeping tabs on this. And again, I know I'm speaking to the choir, but make sure you're doing this. Sole proprietor pros and cons. Most small business owners start as sole proprietors. It's simple and low cost to set up. Basically, just hey, go. You don't even have to go become an LLC. You can just say I'm a sole proprietor. Pay the Secretary of State. Become a sole proprietor. Boom, easy peasy. But the downside, you're responsible for self-employment tax on every dollar you earn, and there's no liability protection. Yes, if you do that, there is a structure issue, and you are getting hit 15.3% on every dollar that you earn. But again, ease of setup, complete control. Downside, there's lack of liability protection, of course, the self-employment tax, and there's limited access to additional funding. Sole proprietors may have difficulty obtaining financing as they lack the formal business structure and creditworthiness of other legal entities. So let's go to LLC pros and cons. Limited liability protection, that's a pro. You want to make sure they can get all the liability out of your personal name. Tax flexibility. Oh, there's lots of tax flexibility in this. LLCs can choose to be taxed as sole proprietorships, partnerships, or corporations, allowing for tax optimization based on business needs. Ease of formation and maintenance. These are forming and maintaining an LLC is generally less complex and more cost effective compared to other business structures such as corporations. Flexible management structure. Again, LLCs can be managed by owners or by appointed managers, providing flexibility in decision making, processing, and potential to be taxed as sole proprietorships. Again, it's a lot of pros, but of course there's are some cons as well. So as an LLC provides some legal protection, it's still taxed like a sole proprietorship unless you elect otherwise, which you less like if you elect the S corp. So, however, it gives you more flexibility if you decide to change your tax status later, like moving to an S corp, and that's where we're going now. S corp. Why is it tax advantage? Self-employment tax reduction. S corp owners can avoid paying self-employment tax on a distribution from the business, resulting in significant tax savings. Now, I'm gonna say this, and I don't want to put, but there's been some talk that they're looking to remove this loophole. But I'm not going to get into that now. But there's been some talk about them trying to remove this loophole and trying to make sure that S corps are taxed on a significantly more amount of their income. But again, that's not it. That's not today. Salary plus tax-free distributions. S corp owners can pay themselves a reasonable salary and take additional income as tax-free distributions from the business. Flexible income allocation. S corps owners may have the flexibility to allocate income between salary and distributions, allowing for strategic tax planning. And S corp lets you divide income into salaries and distributions. You only pay self-employment tax on the salary, not distributions. This can lead to significant tax savings. And however, the IRS does require you to have a reasonable salary, so you can't minimize or avoid taxes completely. Here's an example of an S corp versus sole proprietorship. So let's just say they're both making $100,000 in profit. On the sole proprietorship side, there's 22,900 in self-employment tax. On the S corp side, it's going to be 13,920 in Social Security and Medicare taxes. So again, with an S corp, if you take a $50,000 salary and a $50,000 distribution, you only pay self-employment tax on the salary, saving around $7,500 in taxes. That's basically it. You can move and shake with an S corp. And this is not telling you everybody to go get an S corp. That's not what we're doing here. But we're just giving you a little bit of information. So the traditional W-2 retirement options. Again, there's the 401k plans, the Roth IRAs, traditional IRAs, employer contributions. I mean, W-2 employees can reduce taxable income by putting money in a 401k or an IRA, or even an HSA, right? The 401k limit for 2024 was 23,000 with extra 7,500 for those who are 50 and older. IRAs allow for another $7,000 in contributions. And again, there's another different a catch up there as well if you're 50 and over. But again, you have some options there, and if you have some deferred comp and all the other things as well, there are some options for W-2 employees if you're highly compensated, especially. But these are your options. They're not necessarily limited, but they're limited if you're not a high income executive. So the business owner retirement power moves. So of course, solo 401k, you can put up to 61,000 in 2022. That number is much higher now. I think it's going to be 69,000 if you're 50, if you're over 50 as well. So there's a bump up there. SEP IRAs allow you to put up to 25% of the compensation or 61,000 in 2022 in contributions. Why we're using 2022 numbers? Because numbers are consistently changing, and that number will likely change again this year. So I just want to caveat that. Defined benefit plans allows business owners to contribute up to 245,000 in 2022 annually for retirement, so far exceeding the limits of other plans. We have options. There are options there as business owners to put away a lot of money in these retirement plans. Um, I truly believe, again, like I said, solo 401k contribution limit is up to 69,000 as of this year. So there are some options there. Again, these numbers are constantly changing, guys. So I could be off by 1,000 or whatever. But again, uh, with that being said, there are some benefits with solo Ks and SEP IRAs and defined benefit plans if you are a business owner. Income splitting, paying family members. Now, again, income splitting is a tax strategy that allows business owners to pay their children under the age of 18 up to 14,600 per year, tax free. This is achieved by having the children perform legal, legitimate, real work such as administrative tax, customer service, or even specialized roles that align with their skills and interests by shifting a portion of the business income to these younger family members, the overall tax burden can be reduced. So if you're a business owner, consider hiring family. You can pay your children. It's a great way to shift the income into lower tax brackets and reduce taxable income for the business. Of course, we talk about tax loss harvesting and investment strategies. Again, tax loss harvesting is nothing new. We're strategically selling investments at a loss and to offset capital gains and reduce tax liability. Been more and more difficult to do that. Now, typically, you can do that within an actual stock portfolio. An SMA is that actually owns companies because the majority of the companies in a certain index may be losing money. You can offset your gains by taking those losses. But again, um, it's just simple tax loss harvesting. Offsetting gains with losses. Again, if you have losses from previous years, some people may still be taking them from 2022 when they took those losses. And of course, high tax investments in tax advantage accounts, placing investments with high tax impacts such as bonds and real estate in tax deferred or tax exempt accounts like 401ks or Roth IRAs. It's just about making sure that you're placing the right investments in the right accounts. You don't want to put muni bonds in a Roth IRA or a Roth 401k. It just doesn't make sense, and unless the tax equivalent or the return just makes sense. But I doubt that's the case. So just this is why it's important to contact a financial advisor to make sure they're making the right decisions for you. Now let's talk about the Augusta rule, the 14-day rental exclusion. You can rent out your home to your business for up to 14 days per year without paying taxes on that income. It's a great way to legally move funds from your business to your personal accounts tax free. Now, I'm not saying to do this, but just saying this is just something that's out there. The Augusta rule, the 14-day rental exclusion. This is something that is an option if you wanted to do that. Summary. So, who pays more in taxes? W-2 employees face higher taxes with fewer deductions, but they also have simpler tax filings. Business owners can take advantage of many deductions, but must be proactive in their planning and they must prove their deductions. And bottom line with the business owner, the main difference here, they got to make money. As a W-2 employee, you're working for a company. The money is there. Business owners, you got to go out and make that money. It's a big difference. So how to start paying less in today's taxes? Again, you got to improve your record keeping. Make sure that you maintain detailed records of income, expenses, financial transactions. We use QuickBooks. Claim eligible deductions. Make sure you're working with a tax professional that knows the deductions, that knows the tax code, that knows what's going on out there so you can apply for those deductions. And consider your business structure. Are you an LLC? Are you a sole property? Are you being taxed as an S-Corp? If you're not taking advantage of the tax code and living within those numbers, the S-Corp can be a huge savings. The earlier you start tax planning, the more you can save and the more money that goes into your future self. So here's a call of action today. Let's book a consultation. The links will be in the bottom. Follow us on all social media channels, like I mentioned previously. Join the next webinar that will be coming up. We'll be sending out all the different links to everybody that registered to this one. And download our tax guide, request a comprehensive tax guide. Again, we have packets and things like that we can send your way. Thank you guys for joining us. We appreciate your time. And we hope you enjoyed this webinar. More to come.